I'm Tim Kelly from Montgomery Investment Management, and welcome to this week's Video Insight. Today I want to talk about one of the tougher problems facing value-driven investors in today's market, the problem of how to think about extremely low interest rates. Interest rates are important to valuation because, in theory, the value of a business today can be calculated by estimating the future cash flows that the business will generate and converting those future cash flows into an equivalent value today by applying a discount rate that reflects the time value of money. Financial theory has generally held that the discount rate can be estimated by starting with a risk-free interest rate, something like the return on a long-dated government bond, and adding a premium to that to account for the additional risk of the particular investment you're looking at. One issue that has arisen here is that in the wake of the global financial crisis, long-term government bond rates have fallen to unusually low levels, and on the face of it, discount rates should be correspondingly lower and equity valuations correspondingly higher. We're most interested here in the real discount rate, which is the nominal or headline interest rate adjusted to remove the effects of inflation. Earlier this year, the real rate of return on Australian 10-year government bonds fell to zero, as shown in this chart, and other developed countries have had long-term real interest rates and, in some cases, even nominal interest rates at or below zero for some years now. For much of history, it was thought that interest rates couldn't go below zero because savers would decline to lend money if they weren't being compensated for the time value of money. We now see that it is possible for interest rates to go below zero, but we don't know just how far below zero they can go. In theory, these very low rates of interest should feed directly into asset valuations and increase the value of financial assets like equities, and to a large extent, that is what we have seen happening with asset prices generally rising strongly since the GFC. However, there are a few other points to keep in mind. Firstly, the period of very low interest rates following the GFC has been in part an attempt by central banks to stimulate sluggish economies, and that attempt doesn't look to have been as successful as central banks had hoped. If it had, we would probably be seeing stronger economic growth and rates rising into positive territory by now. Secondly, while we have seen that zero and negative rates are possible, we still don't know much about the longer-term consequences of an extended period of very low rates. And with the GFC now 10 years behind us, the longer-term impacts may be increasingly relevant. It's reasonable to think that an extended period of very low interest rates could increase risks by distorting financial markets, by making it very difficult for savers to accumulate wealth, and by stimulating asset bubbles that ultimately burst. Finally, it's very hard to reconcile zero or negative real interest rates with the idea that lenders need to be properly compensated for the time value of money. The idea that you should pay someone for the privilege of lending them money doesn't seem like an idea that will always be in fashion. To summarise, finance theory tells us that low rates of interest on long-term bonds should translate directly into higher asset values through lower discount rates. However, where those very low rates are part of an experiment that doesn't appear to be working well, may not ultimately be sustainable, and which may introduce a range of unforeseen risks into economies and financial markets, we think investors should at least stop and think before paying the elevated prices that the finance theory might suggest. That's all for this week. We'll be back with more next week, and in the meantime you can follow us on Facebook and Twitter.